Hi, good evening everyone. This is Chirag from Kotak Institutional Equities. I thank the Cipla management team for giving us opportunity to host this call. From Cipla, we have with us today Mr. Umang Vohra, MD and Global CEO, Mr. Qtr4, Global CFO, and Mr. Naveen Bansal from the Investor Relations team. Over to you, sir.
Thank you, Chirag. Good evening and a very warm welcome to Cipla's Q4 and FY18 earnings call. I'm Naveen from the Investor Relations team at Cipla. Let me draw your attention to the fact that on this call, our discussion will include certain forward-looking statements, which are predictions, projections, or other estimates about future events. These estimates reflect management's current expectations of the future performance of the company. Please note that these estimates involve several risks and uncertainties that could cause our results to differ materially from what is expressed or implied. Cipla does not undertake any obligation to publicly update any forward-looking statement which as a result of new confirmation, future events, or otherwise. I would now request Kedar to walk us through the financials for the quarter and the full year.
Thank you, Naveen. Good evening to all of you. Welcome to our earnings call for the fourth quarter of financial year 2018. I hope you have received the investor presentation that we have posted on our website. During financial year 2018, our focus remained to deliver on our key priorities despite multiple headwinds which included the destocking impact of GST in India, challenges on the funding environment for our global access business, and pricing pressures in US. We are pleased to see that India and South Africa, two of our key businesses, have performed well during the year and are set for another strong growth in FY19. We also saw the much-awaited approvals of our complex generics pipeline for the US in the year, demonstrating our capabilities to develop a strong regulated market franchise. The efforts on cost containment and efficiency improvement remained a key theme throughout the year, and it will continue to be in the future as well. All of this is culminated into helping us deliver margins ahead of our guidance. The year also saw significant improvement in cash flows by keeping working capital investments under check and tapering down of the capital expenditure. Let me start with some of the overall financial highlights. In terms of the core margins and the quality of earnings, as alluded in the last earnings call, Q4 is characterized by moderation in margins for us due to reverse seasonality effect for Indian business. While the seasonality and business mix had some impact during the quarter, the underlying gross margin profile for various businesses remains solid and healthy. EBITDA margins for the quarter also saw impact of certain one-time costs related to sales and distribution, employee recruitment and engagement, and some of the litigation-related expenses, which I'll explain in future. Adjusted for this, our Q4 EBITDA trajectory was healthy. Secondly, we also retained our focus to continuously improve the balance sheet health. Our efforts have resulted in keeping working capital investments under check and also tapering down of the capital expenditure. During fiscal 18, we invested about 750 crores on capital expenditure, quite lower compared to our historical trend, and almost 300 crore lower than last year. As of March 18, the net debt to equity is at 0.14 and net debt to EBITDA is quite healthy at 0.72. For this quarter, overall income from operations stands at 3,698 crores. When adjusted for the impact of classification of GST, the normalized overall company level growth stands at 5% on a year-on-year basis. For the full year, the normalized growth stands at 6%, which was driven by strong performance in India, South Africa, Sub-Saharan Africa, and API businesses, which was partly offset by challenges in the global access business. Gross margin after material cost stood at 64% for the quarter, improving by about 75 basis points on a year-on-year basis. During the quarter, we also ramped up our investments in areas of future growth and increased focus on the building strong capabilities through hirings in the areas of quality and regulatory. Total expenses, which include employee costs and other expenses, excluding the exceptional items, stood at rupees 1,811 crores, increasing by almost 3% on a year-on-year basis. Employee costs for this quarter stood at rupees 699 crores, an increase of 6% on a sequential basis. Other expenses, which exclude the exceptional item, include R&D, regulatory, quality, manufacturing expenses, and sales and promotion expenses. They stood at 1,112 crores, which increased about 5% on a Y-on basis. These expenses include certain one-time costs related to sales and distribution for approximately 45-50 odd crores. Total R&D investment for this quarter stood at 7.6% of revenues. The increase was driven by clinical trial charges related to Advair, among others. EBITDA for the quarter before the exceptional item is 557 crores or 15.1% to sales. The exceptional item pertains to a provision towards estimated DPCO overcharging liabilities for the products which are not covered in the ongoing court cases. Tax charge for the quarter is 46 crore. Full year ETR saw the benefit of the US tax reforms. Adjusted for this one-off, the ETR continues to be around 25%. During this quarter, we have absorbed 3 exceptional charges impacting overall PAT. These are as follows. I spoke about the overcharging liability under DPCO of 78 crores, which is an exceptional item line. There is also loss due to disposal of our subsidiary in Yemen. That's about 51 crores, largely linked to the adverse currency movement. That's in other income line. And certain one-time sales and distribution costs of about 45-50 odd crores in other expense line. Profit after tax before exceptional items about 230 crores for the quarter. Our long-term debt remains at USD 550 million, which was mainly used to fund the Invagen acquisition. We also have working capital loans about $66 million, which act as natural hedges towards our receivables. Total net debt to equity ratio is 0.14. Outstanding forward contracts as a hedge for receivables as of 31st March 18 are $93 million in dollar terms and $785 million in South African rand. During the quarter, we have also hedged a certain portion of our forecasted export revenues. The outstanding forward contracts as cash flow hedges as of 31st March 2018 are $141 million and 25 million in South African rands. I would now like to invite Umang to present the business and operational performance. Umang is joining at a different location as compared to our office. Umang, are you on the line?
Yes, I am, Kedar.
Yes.
So thank you, Kedar. Welcome to all of you on our call. This financial year, our focus remained on strengthening our portfolio and deepening our presence in priority markets. We are happy to announce that we have achieved significant progress on our key priorities and almost exceeded all of our expectations on these priorities. I'd like to start with growth in key markets. Key markets continued to deliver strong growth. India business delivered an adjusted growth of 11%, with both prescription and generic business showing strong momentum. South Africa, API, Europe, and sub-Saharan markets continued strong momentum. The U.S. business saw launches of key products where we are seeing increased traction. We guided to an EBITDA range of 16 to 18% this year. Our performance in key markets, coupled with relentless focus on cost and efficiency improvement, helped us deliver the full-year margin ahead of our guidance range. We've reported EBITDA at about 18.6 in this year compared to our guidance range of 16 to 18. Our filing trajectory continued to be strong. The filing rate was with 24 new filings during the year, including almost 7 that were filed as NC-1s. In our launch performance, we're beginning to see the impact of limited competition products. We've launched budesonide, we've launched decitabine, Sevlamer was launched 3 quarters back, and the authorized generic version of Veloxy has been launched as well. We are targeting to maintain 1 limited competition launch in the U.S. per quarter. Our respiratory pipeline, there's been good progress. We remain committed towards establishing a regulated market respiratory franchise and have achieved significant milestones during the year. The year saw the initiation of the clinical trials for generic Advair and groundwork for 2 more trials in the near future. We are targeting 1 sizable respiratory inhalation launch in the U.S. every year, starting next year with albuterol. In Europe, we have expanded our respiratory franchise with FPSM, beclomethasone, and the launch of Ipravent. Our quality focus has stayed strong. We continue to operate our facilities with highest levels of compliance and an all-time audit readiness. During Q4, we had an FDA inspections at our Goa and our Indore plants. We have seen 4 product approvals from Goa since March 18 and 6 since the inspection. Inspection at the Indore plant concluded with 3 procedural observations that have been responded to. I will now take you through our business performance, starting with our India business. We had a very strong quarter with overall India business growing at 13% year-on-year on reported basis and 21% when adjusted for GST. On a full-year basis, the India business grew at 6% year-on-year on a reported basis and 11% when adjusted for GST. This factors a significant destocking in Q1. We continue to outperform the market in our key therapeutic areas. Our North America business delivered sales of $105 million from products and a licensing income of $11 million on top of that for the year. The improvement in sales trajectory is driven by the full impact of Q3 launches on Pulmicort, Dacogen. The normalized last quarter sales could have been higher by 5 to 7 million, which implies a quarterly run rate of 110 million. But we were impacted by product recalls on certain products, as well as our project MIMPA, which has rolled off in trying to reduce the amount of manufacturing footprint needed for the business. Most product issues are already resolved, and we are continuing the supplies in the market. The quarter was also impacted by supply issues that may continue to impact quarter one, but will get resolved by end May. As we alluded to in the last quarterly call, we are cautiously evaluating our marketed portfolio from a value progression and have taken various steps during the quarter to give up volumes in select product categories. This will help us build a healthy profitability profile in the business and release the burden on our manufacturing and supply chain infrastructure. This will have a marginal impact on our revenues, but will drive profitability in the coming quarters. Cipla continues to remain in the top 10 dispensed generics in the U.S. During the quarter, we filed 14 new products, taking the full year ANDA filing number to 24. In addition, Cipla launched generic aloxipelonocetron in late Q4 and has contracted a competitive market share. As alluded to earlier, we target to maintain our limited competition launch trajectory with one such launch every quarter. The SAGA region, which includes South Africa, Sub-Saharan Africa, and Cipla Global Access business, recorded a growth of 6% in FY18 on a year-to-year basis when reported in USD. This was impacted favorably by the strengthening of the ZAR USD versus the previous year. Our South Africa business delivered yet another strong quarter, recording a 16% growth and adjusted for animal health divestiture versus in the local currency. As per IMS MAT March 18, South Africa business grew at 10.7% in the private market versus 8.4% market growth. Our global access business degrew 54% over last year during the quarter due to tender phasing and challenges in the funding environment. Our Europe business continues to build strongly on a profitable trajectory. While Q4 saw a decline on the year-on-year basis, largely due to one-time benefits in the same quarter last year, the full year saw a 4% year increase with considerable improvement in profitability. We continue to build a strong DTM business in the UK and have expanded our respiratory franchise with the launch of Ipravent. In emerging markets outside of Africa, quarterly sales remain flat year-on-year basis in dollar terms. We also launched a front end in Colombia this year. We have been working on strengthening our business development efforts across these markets to drive future growth. We are targeting 6 biosimilar deals across 4 key emerging markets by the end of this financial year. We have already filed 2 biosimilars in Algeria. Expect 1 approval over the next 1 year. We will also file at least 1 biosimilar in Australia by the end of the year. These filings and approvals will help us drive significant growth in emerging markets over the medium and longer term. As alluded to in our earlier calls, we are committed towards building a strong specialty portfolio. The development of the tizanidine patch is progressing smoothly. As you are aware, we monetized our first specialty investment last year with the divestment of our stake in Chase Pharmaceuticals to Allergan. During this quarter, we received a part of the milestone payment. As we enter FY19, we continue to operate under various challenges across our markets. Having said that, our existing diversified global footprint and strong pipeline allows us to aspire for market-beating growth. FY19 will be another year of strong focus and execution to deliver on this priority. In terms of margin expansion in our internal budgets and target margin expansion driven by ramp-up of new launches in the U.S. and a continuous improvement in our operational efficiencies. For our India and South Africa business, we will continue to maintain leadership position, targeting above-market growth and continuing to funnel high growth in strategic therapeutic areas of respiratory, oncology, cardiovascular, and HIV, respectively. We will ramp up our U.S. business. It's poised for good growth during this year as we ramp up on our key differentiated launches. The reported growth may be a bit moderated to the volume rationalization that we alluded to earlier. We are targeting our sizable respiratory inhalation launch in U.S. every year starting next year with albuterol. In terms of R&D, we will continue to invest significant resources behind building a strong pipeline to drive sustainable growth with over 20 targeted filings in FY19. This year will also see higher investments towards clinical trials for key respiratory assets and a focus on building a pipeline of specialty assets. We will continue to ensure quality and compliance at our manufacturing facilities, and this is a non-negotiable agenda for us. I would like to thank you for your attention to Cipla and will request the moderator to open the session for Q&A.
Thank you very much. Ladies and gentlemen, We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touch-tone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Manoj Garg from HealthCo. Please go ahead.
Hi, thank you. Hi, Umang. Hi, Qtr. I have a few. One, so it seems like there's a lot of moving parts, a lot of moving expectations within the U.S. market. So I was wondering if you would be willing to provide a general guidance number similar to what you've done for the Indian market in fiscal 19. Two, on generic Advair, those manufacturers that were in the first wave have all received CRLs. I was wondering if you could speak about what you have learned, either from the FDA or indirectly, from those CRLs to adjust your own program. And then lastly, 3, just wanted to better understand the logic of raising the 2,000 CR in equity while your stock's at a near a 12-month low, and then just what the purposes would be for that total 4,000 CR raise.
Manoj, thank you. I'll take questions first and question 3. I'll request Umang to answer question 2. In terms of the domestic business, we are pretty on a strong footing, Manoj. In quarter 2, quarter 3, and quarter 4, whatever targets we had set for ourselves internally, we have exceeded them. Growth is in healthy double digits. Prescription trends, some of our productivity of the field force, I think that looks pretty healthy. So all the health parameters for a branded business in Indian market and the generics non-prescription market, we are quite confident. That's the reason we said it looks like that we are set for $1 billion consolidated revenue for domestic market in FY19. That's a little bit of overview for our India market. That's an answer to your question 1. On question 3, Manoj, if you recollect, last year we had taken an enabling resolution to raise funds, about 2,000 crores for debt and 2,000 crores for equity. We're just carrying forward that resolution in case we need funds for our inorganic initiatives.
Yeah, and I'd like to take question 2, which is your specific question on generic Advair. Look, so I think I think we have to think about what people are getting as comment letters in 3 buckets. One is where people have had a genuine problem in the clinical trial for this product, and I think there have been one where, or at least 2 players where we've seen that the clinical trial outcomes are not linear to their expectations. And I think, if you have a situation like that, you have to go back and repeat your trial. There's no other option. So I think it comes back to what we've learned from that is, the right trial protocol, the right sample size. And I think, for this, the 2 actives in Advair have a history of being notorious in terms of just stable, in terms of getting an outcome that you want, which is fluticasone and salmeterol. So we've dealt with this in a limited way when we got our Europe approval, but every product is unique and different in its own way. The second category that comes out in this is genuinely where you have a problem with your drug or your device, and it could be a CMC problem, and I think quite a few people have got comments like that. The fact that we've had experience in this product, that we've been selling this in India, we've been selling this in Europe now, adds to our confidence, and we're humble about the challenge ahead, but we're also at the same time fairly confident about what we can accomplish with Advair. And the last one is really the regulatory guidance, and this is something that you have to learn while you're on the go. We've become a little bit more informed based on what we've heard on albuterol from the agency, and that's guiding our thinking on how the agency wants to think about further inhaled products in this category. But this is something that, like others, we will also learn as we go ahead. But we've, based on the intelligence in the marketplace, we're beginning to gather what the FDA is looking for in terms of filings, and I think that's a continuous journey that we're updating ourselves on.
Okay, now that's very helpful color from you, Umang. Qtr, just really quickly to follow up. So on my question 1, I was really looking if you would be willing to, put out some sort of guidance on the U.S. business, similar to what you've done with India, because there's just a lot of moving parts that are specific to your business in terms of new launches, new therapeutic areas, and portfolio optimization. So just putting them all together is difficult. So I was wondering if you could assist in that. And then back to 3. So if I'm hearing you properly, the purpose of the 4,000 CR raise is just general operational?
Manoj, I guess you have answered your question yourself. I think the determinants of the U.S. sales are varied and very tough for us to precisely estimate on a quarter-on-quarter basis. So we would desist from giving any guidance, but you should watch us for scale-up in some of the complex generics launches that we have already made and unlocking of the pipeline in the coming quarters.
Okay. All right, thank you. Best of luck.
Thank you. The next question is from the line of Sayan Mukherjee from Nomura Securities. Please go ahead.
Hey, hi. Thanks for taking my question. The first question is regarding the other operating income. I think you mentioned about $11 million or some one-time income this quarter. Can you just explain that? And even adjusted for that, this number looks higher. So if you can give some color.
Sayan, in the other operating income line, we book several items. This include export incentives, sale of services, certain sale of ANDAs that we rationalize at our end. Then there is technical know-how, there is licensing fee, there is scrap sales. So all these add up. These are not exactly secular on a quarterly basis. They move up and down. This quarter, the only unique item is some patents and licenses that we sold to a U.S. party. That's about $11 million. But otherwise, I think you should probably take a quarterly average rather than looking at this quarter per se.
Okay, thank you. On the U.S. revenues, would you say that, the Pulmicort numbers are fully there, or there is scope for that to increase in the coming quarter?
Sayan, both Pulmicort and Dacogen, there is scope to increase. I think we referred to some of the serviceability issues, amongst speech, and couple of recalls as well. So I think the revenues in Q4 are not fully reflected with the market opportunity that we could service. As we are speaking, the serviceability issues are getting addressed. So June quarters, could reflect some of these challenges as well, but in the subsequent quarters, you will see the benefit of share coming in.
Okay, great.
Umang, you want to add anything?
No, I'd just say that I think if I were to just look at Sayan where we are in terms of our contracted share, on Pulmicort, I believe we have reached our contracted share, and it's an issue of the customer pull-in. So I think Pulmicort will recover nicely in Q1. Dacogen, we had a supply issue. We had to hold back some supplies in the market, which is now resolved since then. So both Dacogen and budesonide should see an increase in our revenues in Q1. We've had some supply issues for other products, which probably we are, as we are beginning to rationalize our portfolio, those will continue still in quarter, pretty much in this quarter as well.
Got it. And Umang, you mentioned about albuterol launch. Just wanted to clarify, you're talking about fiscal 19 as launch for albuterol?
Yes, next year, not in this year. Typically could be Q4, but we don't want to guide for that. It will probably be in the next year.
Okay, fiscal 20. Okay. And any timeline for the Advair trial and filing at this stage?
So I think we will file. So the trial will start. I think we've. Sayan, we're not guiding for that right now, but unlikely that it will be a current year filing.
Okay. And just one last question, Kedar. You mentioned global access down 54% in this quarter. Can you share the number for the full fiscal year, fiscal 18?
We have done about $110 million or so for our global access business.
In FY18. And how much was it in FY7 last year?
It was a little bit higher than 145 million or so, but we could get you the exact number, Shine.
No problem. Thanks a lot.
Thank you. The next question is from the line of Neha Manpuria from JP Morgan. Please go ahead.
Thank you for taking my questions. So first, on the gross margins, while I understand you mentioned that there is some reverse seasonality in India, but given that we had some bit of contribution from Dacogen and Pulmicort in the quarter, I'm surprised by the quarter-on-quarter erosion in the gross margin. Especially we had, certain one-off items with milestone payments, which would indicate that probably the margin is even lower. Anything you would want to call out there?
Neha, the benefit of Decitabine in the current quarter was very low because of the recall that we referred to. In our view, the underlying fundamentals for each of the business gross margins are solid. They remain healthy. We don't think they have worsened as much. There has been seasonality and there's been some business mix, product mix issues. I think we are within the secular range that we have always been seeing for Cipla.
And ideally, this range should improve as we, as the launches, large launches, the 3 big launches sort of ramp up, and we also see, monetization of unlocking of our pipeline, as you said. Yes.
Tough to quantify, but directionally, yes, Neha.
Okay, and my second question, is given Perrigo's CRL, the CRL that Perrigo received, have we also seen issues on our filing for Albuterol? And I know Umang mentioned that this could be FY20, but any challenges that we're seeing there?
Well, let me try and take that. I think, when you say challenges, I don't think we have the challenges of the clinical study and what we saw in the study. That's not a challenge for us. I think there have been some regular correspondence that needs to be answered to the FDA, which we are in the process of doing. And, we are quite confident that we should be able to do it in due course. So nothing which we believe will stop us right now.
Okay. And my last question, Umang, on, Advair. GSK has been reducing these, sales expectations for Advair. You've seen a bunch of CRLs, but it's still uncertain as to who would be number 1, number 2 there for generic launch. But do you think it's a much smaller opportunity as we start trial for this versus what we'd expected, a couple of quarters back? And, as you look at return from a portfolio perspective, does it still make sense to invest in Advair?
Yes, I think that let me answer first by saying yes. Because 2 things have happened, Neha. When we penciled in our market entry, we said we would be 4th or 5th. Right? And we also said that the opportunity would not be as large as the 4 billion that it was. So we had assumed some decline. And in our view, this was to be a good 50-100 million opportunity, and it would continue for some time. Right? Now, 2 things have happened since then. The first thing is that the market is, I wouldn't say shrinking, I would say the market is shifting to Brio.
Yeah.
Right? So that's one. And the second is I'm not sure whether we'll be 4th or 5th now or could even be better than that. Yeah. Right? Depending on where everyone else, because 1 or 2 of the players are back again to the starting board on the clinical trial, which is where we are today. So having said that, that's one item. The second thing that I would just urge everybody to watch out for is that I am not so sure that once this product becomes generic, that there won't be a managed care play here. Because I think the shifting to Brio is happening because Brio is at a certain price, which may be the same as Advair. But when there's generic Advair, I'm not so sure that it will be possible to probably continue to shift patients off Advair onto Brio. So my guess is that you could see an expansion in volumes in the Advair segment.
Fair enough. Thank you so much, Mark.
Thank you. The next question is from the line of Nitin Agarwal from IDFC Securities. Please go ahead.
Hi, thanks for taking my question. On the, with all this increase in R&D plan for next year with a couple of clinical trials around the inhalers and all starting up, given the fact that our top line growth still, is not going to be in very high double digits, probably in early single digits, early double digits, the guidance you've suggested. How do we see the R&D cost trending out for us?
Well, I think we are very clear. We are not going to allow R&D to go more than 8% because we can't afford it. I think we are very clear about where R&D is going to head. So it will not be higher than 8%.
Which is almost near the levels where we sort of finished the year at.
Yeah, I think this year, we finished this year about 7.1, 7.2. We're going to be roughly the same. I mean, we'll be up to 8% on whatever is the incremental revenue that we get.
So are we looking at some partnership financing strategies, or you think, the growth is going to be enough to take care of the incremental R&D needs?
Yeah, we think so. We think the growth will be enough to take care of the incremental R&D. At the same time, we look at if we can de-risk it a bit more, we can, because we'll have 3 or 4 clinical trials going on for respiratory programs in this year.
Okay, thanks. And Kedar, on depreciation, now, what is the base number that we should go with on the depreciation amortization line going forward?
I think you should take current quarter's base because there is not much, exceptionality for this quarter. So especially for Invagen, I think as the new products are coming into market, that part of the intangibles do get into amortization. So I think pretty much current quarter is the base. And obviously it could, go through the cycle of reduction and increase based upon the completion of the life and new products getting launched.
Thanks. And the last one, Kedar, on the seasonality in Q4, I mean, barring the India business which sort of comes off a bit in Q4, what are the other sort of elements that we should watch out for, because we've had a pretty sharp QOQ change variation in the EBITDA profile for the business. I mean, are there any factors which come into play in terms of any lumping up of expenses and staff costs and the expenses towards the end of the year?
Yeah, so if you are referring to EBITDA margins, I think those 2-3 elements that I referred to, those have had an effect. In terms of gross margin, our API business is very healthy. And the API business gross margins are much higher than the company gross margins. So I think there has been some mixed impact, Nitin, in quarter 4.
Okay. Thanks and best of luck.
Thank you. The next question is from the line of Anmol Kanju from JM Financial. Please go ahead.
Yeah, hi, I have 2 questions. One is that $1 billion domestic sales, I mean, that builds a fairly sharp uptrend in the domestic growth rate relative to what has been observed in past, like 3-5 years, our growth rate has been 6-7% and 8.5% CAGR, and I think $1 billion bills virtual doubling of that will be growing at 13-14% if that number was to materialize. Just wanted to understand what gives the confidence in terms of having put in drivers in last 12 to 18 months, which would signal such a sharp acceleration in the domestic growth trajectory.
Umang, can you take this? Yeah, so I think probably we have lost Umang's line. So Anmol, we referred to, some of these factors that we have worked on in the last couple of years. I think there are several engines which is helping us deliver this above market growth. I think starting from a transformation from a geography-based structure to a therapy-based structure. Then some of these in-licensing deals that we have signed with companies like Novartis and Roche. And add to that the fact that the productivity of the field force, we have been working as well. And some of the initiatives to reach patients, to expand therapy, to have some of the therapy shipping initiatives, so quite confident to reach to 13, 14. And many companies are in that zone. So it's not a zone which is outside the realm of possibility. So we're taking that as a challenge.
Thanks. That's helpful. Kedar, the second question is that in the light of, some of the investments regarding R&D and some of the other cost pressures also that the business should entail, and the fact that we have over-delivered on our EBITDA margin guidance for the full year, do you think this is pretty much a ballpark that we should work with from an FY19 perspective?
So, I would desist from giving a specific guidance, but we believe that our opportunity in optimizing costs, improving the business mix, and, squeeze out efficiency, coupled with the monetization of the US pipeline, I think we do have opportunity for margin expansion. And that's what we have guided to. We're not quantifying at this stage, but we'll work towards it.
Okay. Thanks. And my last question before I get back into the queue, slight repetition of a previous question. We've seen, quite a few times that fourth quarter, outside of the domestic seasonality that we see, there is also cost lever pressures which come in. How should we be looking at margin progression throughout the FY19? So, do we build a similar trajectory that, FY19, also Q4, we should see fairly sharp dip in margin profile? Because that seems to be, the trend in last 4 out of 5 years.
No, that would be fair because that's how the business book mix would operate. So as you know, in quarter 2, we have heavy acute season in India. In quarter 3, we have a very heavy respiratory season in India. And accordingly, the margins will get played out. So either be the impact of dominance of each therapy within the Indian business coupled with the scale-up of the launches in US. There are multiple factors, so it will be tough to precisely give you an idea how it will pan out quarter on quarter. But I think quarter 3 to quarter 4 drop is pretty much the reality. I think over the years for us that has played out. So I think good to factor that, good to model it that way.
Thanks, Kedar. Thanks very much.
Thank you. The next question is from the line of Sameer Baisiwala from Morgan Stanley. Please go ahead.
Hi, thanks. Kedar, just on EBITDA margin outlook for fiscal 19 and beyond, I know you said that you won't quantify it, but 2 questions over here. Is this going to be now meaningful, substantial? And second, which is like, more than 150, 200 basis point. And second is, when you say better revenue mix, what exactly are you referring to? Because I think India continues, South Africa continues, US continues to have complex. So what's that revenue mix change that you are expecting in fiscal 19?
Yes, so 2 reflections, Samir. One is, see, we are in that zone now. I think, few years back we were sub 14. Now we are at a zone of about 18 to 19%. So I think each incremental percentage point is obviously going to be very satisfactory, and that's how we are going to work towards. We believe there is some element of cost efficiency that we could work on, which will give us that leverage. And the numbers do not reflect as much US leverage. So when we refer to revenue mix, I think, probably the non-US geographies are contributing in full, is that portion of the US, that incremental contribution of products like Dacogen, which will contribute to margin improvement.
Okay. So basically it's US-led revenue mix that you had in mind when you said.
That's true.
Okay, and then just on the U.S. part, Uma mentioned that there was a slip of about $5 to $7 million in revenues because of supply constraint. If I heard him correctly. Now, does this take into account everything, including Pulmicort, Dacogen, or that is over and above that?
No, it's pretty much all the reasons, which we referred to. I think all combined probably we have a feeling that we could have done about 7 million more in this quarter. And as we are speaking, some of this is getting addressed. So by June probably we should be in full in terms of supplies.
Okay. One final question, Kedar, from my side. If you look forward revenues, I know you gave a qualitative color, but on an overall basis, are we looking at 15-20% that type of a zone, or 10 to 15? I mean, some color over here would be very helpful.
Yeah, Samir, I think it's very tough. Corporate level revenue growth guidance is very tough. I think what we're saying is, I think in India market will continue to outperform. In South African private market will continue to outperform. US, we're going to have healthy double-digit growth. Balance pieces of emerging market, API, Europe, etc. are not predictable as much. And what's probably we do not have full visibility is the funding environment for our access business. So how it adds up, we'll have to see. I think that's going to be interesting. But, in terms of ability to forecast, we are in greater control for India, South Africa, and US business.
Okay, just a follow-on on this, Kedar, with your permission. Now, when you say you'll do double-digit in the U.S. On a base of give or take $420 million, that we are looking at $40-50 million incremental, and I'm assuming this is a net. Now, when you talk about one, a complex or niche launch every quarter, and plus other Me Too's, incremental $40-50 million doesn't seem, to tie up with that. You're almost implying $10-15 million as your definition of, or even less, of a niche product.
Yeah, so as you know, this the absolute sales in US is a function of your erosion and the timing of launches, pricing and share and everything. So in the past, we have seen some of the limited competition launches have not lived up to the promise. So we are living at this at the current stage, and let's see what happens.
Okay, great. Thank you so much.
Thank you. The next question is from the line of Surya Patra from Phillip Capital. Please go ahead.
Yeah, thanks for taking my question. Kedar, just one clarification first of all. The licensing income, what you have mentioned about $11 million, whether that is added to the US revenue or it is separate of that?
No, it is not part of US revenue.
Okay, fine.
Including that part of the licensing income.
Okay. And regards the inorganic, the margin front again. So since last few quarters, like 7-8 quarters, you have been saying that, okay, you will be maintaining at least 100 basis point kind of expansion YOY, and that has been happening. So considering the R&D spend, rising R&D spend for next financial year and the visible challenges also, in US, though there are opportunities in US alongside, but still this 100 basis point kind of expansion is a kind of a possibility for FY19, or it can be.
So we do not want to guide anything at this stage for fiscal 19. See, some of these challenges that you referred to, Surya, are not new.
Yeah.
We'll live through those day by day. But we are also excited by the opportunity across our markets.
Okay. And one more on the biosimilar front. So you have already mentioned about it, but if you can give some sense that, okay, what is your thought process about it and how you want to scale it up, the operations, and what all that you are currently doing and achieving on this front?
Umang, are you on the call?
Yes, I'm on the call. I take it.
I think the question was on biosimilars roadmap for future, in what form and shape you're thinking about it.
Yeah, got it, Kedar. So I think here what we are doing is each biosimilar outcome in each market is a binary outcome. So some markets you will get $5 million of revenue, some markets will get $10 million. It really depends on how big the innovator is. So we have a set of markets in the emerging side of the world where we believe we are competitive to play. And I think some of those markets we are trying to play. We filed the products, we've closed the deals. So I think as these products begin to unlock, you could have a trajectory in the emerging side of the world, which could be between 3 million to 5 million to 10 million per product as it unlocks per country.
Okay, something on the pipeline, sir?
I think you could expect that most of the, most of the MABs which are going off patent recently would be covered. So could expect trastuzumab, bevacizumab, rituximab.
And as you have already mentioned that it is largely about the emerging market and
That's right.
Yeah, okay. Just last one question on the inorganic growth. See, considering this fundraising plan and all, so are we still considering something like inorganic growth in any of the market, given that the ongoing challenges you might possibly get a better deal?
No, actually, we are not in the mood to deploy too much of capital into the U.S. side of the world today, because I think that market doesn't, the capital that's being deployed is largely through our P&L and whatever little through our balance sheet.
Okay.
But we could, and the resolution we've taken is more enabling. It doesn't mean that we will be doing deals worth 4,000 crores. So as and when they become available, we will be hopeful. But we will not buy unless we see a synergy value in the transaction.
Okay, fine. Thank you, sir.
Thank you. The next question is from the line of Naveen Bed from Aditya Birla Money. Please go ahead.
Thanks for taking my question. Hello. Yeah, thanks for taking my question. I joined the call a little late. Can you just give a little more color on what was the exceptional item this quarter?
Naveen, can we take it offline, please? You could get in touch with the investor relations desk and we could explain the background of the item.
Yeah, sure. Thank you.
Thank you. The next question is from the line of Nimish Mehta from Research Delta Advisors. Please go ahead.
Yeah, thanks for taking my question. Two questions. One, again on the margin side, and Kedar, if we were to adjust for the one-time 11 million that you're talking about, we're actually talking about an EBITDA margin drop on a YOY basis, which also would adjust for the seasonality in the Indian business, in the domestic business. So I'm trying to gather, you were talking about an underlying EBITDA margin of much higher than what is being reported. So some color on what do you think would be the underlying EBITDA margin or the gross margin would be for this quarter, Q4?
Yeah. So, Nimish, we referred to the business mix issue. I mean, as you know, from a packing order standpoint in Cipla, emerging market business after API is one of the highest in percentage terms. So as we have a lower mix of some of those businesses, and if we do not have adequate contribution from products like, Disrabine, I think this kind of behavior happens. As we said, there is no fundamental dilution in the margin profile. It's purely business mix and it's purely sequential dip in the Indian business revenues.
So is it fair to assume that all the businesses that we have not seen any significant erosion in margin on a YOY basis?
No.
Okay. Second, just a clarification, when you're talking about albuterol launch, we are talking about generic Proventil, am I right, or we are talking about generic ProAir?
We're talking about generic Proventil.
Generic Proventil. And I guess there is no Para-IV filing which is required. Is that a fair assumption?
Yes, that's fair.
Okay, fine. Last you talked about a TAD on this product in Q4 FY18, if I remember well. Any update on that TAD, or have we seen any delay in that or something on that sort will be helpful?
On TAD on what? On
Proventil.
Yeah.
I may be wrong.
Yeah, we have received our observations from the FDA already. We are about to submit a revised package to them, and then they will review it. So it depends on what TAD they will set now.
Okay, understood. If I squeeze one more, just if you can let us know the number of new launches you made in the domestic market, and that is excluding line extensions, that will be very helpful.
Yeah, so Nimish, those are many, and some of the in-licensed have been very high value. The IR desk will get back to you on the exact number of launches.
But some ballpark will be helpful, and then I can obviously follow up with that.
In fiscal 18, there will be a lot of organic launches as well. I think we'll come back to you.
Okay, thank you.
Thank you. The next question is from the line of Alok Dalal from CLSA.
Yes, hi. Umang, what led to the supply issues in the U.S.?
So it's three items.
Yeah.
One was that, the new product scale-up that we had to do for new launches that we were doing. That was more out of our India side. The second was in the U.S., we had an issue around the products that we are trying to rationalize on account of, we want to reduce the manufacturing load in the U.S., and therefore that led to some amount of issues. And then we had a quality issue on one or two products, which led to us not being able to fairly sizable products for us in the U.S. But most of them are back now. They're all back. I think all these issues are more or less resolved, or will be resolved in the next 1 week or 2 weeks. And then I think we will have, they're saying even this quarter we might have some of an impact, but I'm not so concerned from a long-term perspective whether this begins to impact us at all or not.
Okay, and do you see any major market share loss because of these issues?
I'm not sure if we'll have market share loss. I think on the new launches, we are pretty much back to where we want to be. Our contracted share is now beginning to show where we want to be. On the ones that we were out for a while due to our manufacturing footprint optimization, those we have definitely got back. On quality, where we lost a little bit of share, that's fine. I think we'll be able to claw it back because those are fairly concentrated markets. So I don't think anybody will be able to step up to take all of our share.
And how are you reading the overall industry dynamics now in the U.S.?
Look, I think for the right product, the U.S. is still a great opportunity, right? So when I look at, when I look at what Aurobindo could do out of Sevlamer, what I look at, even what we are able to do out of budesonide, I think the dynamics are right, but you have to have the right product, and it's a question of timing. I do think that the pricing erosion environment, I would like to believe, is settling a bit. I think we're probably reaching the bottom end of this, and I think it's beginning to settle because, frankly, there is not too much more room to where it can go. So I think it's settling a bit. I think you'll begin to see some good launches that are coming up, not just for us, for other players as well. And hopefully that begins to restore confidence in the U.S. opportunity.
Okay, great. And one last question. You mentioned about investments in specialty products. So the marketing infrastructure that you will need to create for that cost will hit you sometime in fiscal 20. Is that fair to assume?
Yeah, it's not in the next year. It's not in the next year unless we buy some existing company. It will come in FY20.
Fiscal 20. All right. Okay, thank you for taking my questions.
Thank you.
Thank you. Take one last question, please.
Sure. We'll take the next question from Sameer Baisiwala from Morgan Stanley. Please go ahead.
Thanks for the follow-on. Just Umang, to tie up with the previous speaker, for the U.S. market, what's the future for the wrong products? You talked about the right products, but for Me Too generics also, when you see that the industry leaders, Teva, Sandoz, everyone is exiting, even you are also exiting, someone has to supply those volumes. That's one. And second, is your engagement with the customer changing? Do you see a difference versus 1 year back and now with them?
No, actually, so good question, Sameer. I think with the customers, let me answer the customer question first. We're not seeing any difference in engagement. On the other hand, what we are hearing from customers is that a lot of people are walking away from products. We need sustainable suppliers. So I think the customers really want longer term, more sustainable supply, and I think those conversations are happening as we speak. I think in terms of your first part, we are exiting product categories where we believe we are not competitive. So, I would hate to be in a product category where I have a 10% gross margin, and if I'm ever out of stock, I get hit by a penalty which basically negates everything that I earn on it for the full year. So my list of 10% where I may be uncompetitive may be very different than Teva's list of 10% where they are uncompetitive, right? And I think there was a while where the generic industry operated with the principle that you should load your plants if it's running because you amortize your cost base. And today I think the question people are asking is, why do you want to load yourself on your plant base if you can do with one shift less and your overall margin mix improves? And I think that's the type of deliberation that we're having. We're not exiting categories where we will be one among the 5 or one among the 4 to supply. We're exiting categories where we're one among the 12 and we are uncompetitive. So if we exit, Teva exits, somebody else exits, there's still going to be 8 players in that market. So it improves a bit, but it's largely driven by where we believe we have a competitive cost position and where the product is frankly meaningful to us.
Okay, great. This is very helpful. And just one second question on India market. Are you seeing the impact of government's initiative on Jan Aushadhi? Do you see this expanding more and more pharmacies and what it can do to your India business?
No, I'm not sure even at our level or even at the level of the Indian Pharmaceutical Alliance, which is an organization which represents multiple companies. I don't think we're seeing the full-blown effect of the Jan Aushadhi stores. I think the IPA is working with the government to make sure that that there is success that they see in the Jan Aushadhi. Right now, I don't think the Jan Aushadhi is a very well penetrated into the market volume as yet.
But can it hurt your future India growth?
Well, not in the immediate term, from how it is running right now. Not in the immediate term.
Okay, great. Thank you so much.
Thank you. Due to time constraints, that was the last question. I now hand the conference over to the management for their closing comments.
Okay. Thank you everyone for your interest in Cipla and for attending our call today. In case you have any follow-on questions, you can write to us at investor.relations@cipla.com. Thank you so much and have a good evening.